I think all eyes right now should be on silver. There's about 250 million ounces outstanding for the July expiration with only 3 days left. And 250 million ounces, I mean, the world only produces 850 million ounces total production for the year. So you're looking at what? 30% of global production may be standing for delivery 3 days from now. If we got to 40 or we got to 50, what you're talking about is silver will outperform gold 2-to-1 as far as purchasing power. So what I'm getting at is the risk reward of owning silver right now is hilariously in your favor.
Gold's recent rally reflects a convergence of deepening geopolitical tensions and a strategic realignment by major financial institutions. With escalating conflicts in the Middle East and Eastern Europe, investors are rapidly repositioning away from risk-sensitive assets. As David Erfle aptly notes, gold is the safe haven of choice. It's replaced treasuries as a safe haven, underscoring a loss of confidence in sovereign debt instruments. Supporting this trend is an unprecedented wave of central bank gold purchases. According to the World Gold Council's 2023 data, official sector buying reached a record 1,037 tons, signaling a deliberate move away from dollar-denominated reserves and toward tangible, long-term value. While gold leads this shift, silver is positioning itself for what Bill Holter describes as the most explosive setup in decades. Having decisively broken through the $35 level, silver has completed a multi-year base, supported by a classic inverted head and shoulders pattern, widely viewed as a bullish reversal signal. Yet beyond the technical breakout, the pressure in the physical market is intensifying. Roughly 250 million ounces, equivalent to nearly 30% of global annual production, are reportedly standing for delivery. Holter warns that if the system fails to meet those obligations, it could expose deep vulnerabilities in the paper-silver market, and, in his words, once there's a failure to deliver, everything built on paper contracts starts to unravel. What makes silver especially compelling is its dual identity as both a monetary metal and a material with significant industrial applications. From clean energy and electronics to medical devices and defense, silver is critical to multiple high-demand sectors, giving it a structural advantage over gold in terms of real-world utility. Despite this, silver remains dramatically undervalued, trading at a fraction of gold's price, with the gold-to-silver ratio still near historically extreme levels. Bill Holter has long emphasized that silver is gold on steroids, not only because of its volatility, but due to its potential to outperform during periods of monetary repricing. With U.S. sovereign debt now exceeding $37 trillion and global imbalances mounting, a systemic reset appears increasingly likely. And in that event, silver may deliver the most asymmetric returns in the entire metals complex. Now, we present the clips from Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We're absolutely still in a bull market. The bull market's intact from a technical standpoint, as long as it holds. I guess the number would be what, 2,800. That would be a 20% retracement, which would be a bear market, which would break the bull market. I think all eyes right now should be on silver. There's about 250 million ounces outstanding for the July expiration with only 3 days left. And 250 million ounces, the world only produces 850 million ounces total production for the year. So you're looking at what, 30% of global production may be standing for delivery 3 days from now. That is almost a perfect inverted head and shoulders, which tells you, if you look at the breakout itself, we actually got down to, I think, about 35.10, 35.20 this morning. So, that's a probe of the breakout level. We may, it may take a little bit of time to chop and hold this 35 level before it goes higher. And like I said, 3 days from now, that could be a huge fundamental event where you've got like I said, 250 million ounces could stand for delivery. There's no 250 million ounces anywhere in the world to deliver. I've said all along that I thought silver would be the detonator to gold, and gold will literally destroy all derivatives. I mean, once there's a failure to deliver, all derivatives are going to fail because everything runs on confidence, and it would show that you've got a failed contract. What's the value of a contract that cannot perform? The answer is zero. So what you're saying there is paper's worth zero, and thus what is the real thing worth? The answer is there's no telling what the number is going to be, but it's going to be, when all is said and done, many multiples of where pricing is right now. Yeah, there's no issue for institutional entities as far as storage is concerned. I mean, they can find the storage space. And you're speaking right now of the investment demand. Mm-hmm. And silver is different than gold. Gold is basically all investment or monetary demand. Silver's got so many different uses. Silver's got medicinal uses. It has industrial uses. It has technological uses. Every time you see a Tomahawk missile launched, there goes a monster box. I mean, there's over 500 ounces per Tomahawk missile. So silver, you've got to look at a little differently because there's not just investment demand. That's not the primary demand. The primary demand for silver is, as I said, medicinal, technological, industrial. There's absolutely upside potential in the gold price. I mean, just do the math on the amount of gold that the U.S. says they have versus the amount of debt outstanding. And when I say debt outstanding, I'm just talking about on-books debt. Mm-hmm. I'm not talking about Fannie Mae, Freddie Mac, Ginnie Mae, all the loan guarantees, Medicaid, Medicare, all the guarantees. You're over $200 trillion. But if you just use the 37 trillion divided by 8,400 tons, the number you're looking at, if we had to pay our debt off in gold, we would have to price gold at about $135,000 an ounce. So there's tremendous upside to gold, but there's, in my mind, at least double the upside in silver versus gold years ago. But silver is going to be gold on steroids. If you look at the fundamentals, if you look at what's going on geopolitically, I mean, on any given morning, you could wake up and gold's up $100, $200, never to look back. I mean, if we woke up one morning and found out that a tanker or a couple tankers hit mines in the Strait of Hormuz, what's that going to do?
Right.
That will break confidence. And God forbid should we wake up one morning and find out that a aircraft carrier got sunk. Mm-hmm. I mean, that would be a disaster because in the past, the dollar has always been the safe haven for foreign monies. What happened, if something happens that breaks confidence and the dollar/treasuries are no longer viewed as the safe haven, you're looking at game over USA.
Yeah.
And Danny, the reason it's game over USA is, what are we hearing now? That the next 4 years, the debt is going to increase by 10 trillion. That's a disaster. And what that means is we need to borrow 10 trillion just to keep the doors open.
In a recent interview, Bill Holter warned that the global financial system is approaching a dangerous tipping point, where even a single destabilizing event could shatter the long-standing perception of safety surrounding the US dollar and treasury markets. He warns that if something drastic, like a major military loss, were to occur, the immediate consequence might be a catastrophic loss of confidence in the dollar. This erosion of trust, combined with projections of an additional $10 trillion in U.S. debt over the next 4 years, signals deep structural issues. The scale of borrowing needed just to maintain current government operations exposes how unsustainable the system has become. Holter argues that without external demand for U.S. debt, the country may find itself unable to finance its obligations without triggering severe monetary devaluation. In his view, the very pillars that once upheld the dollar's dominance are now beginning to crack. He also highlights worrying trends in bond markets and central bank control. Despite the Federal Reserve's rate cuts, yields on long-term treasuries have risen, suggesting that the Fed has lost control over interest rate dynamics. Holter interprets this as a major red flag, indicating that markets are now pricing in far more risk than central planners anticipated. At the same time, the US dollar index has breached multi-year support levels, pointing to renewed weakness ahead. In a worst-case scenario, Holter envisions a sharp decline in the dollar that could rapidly lead to commodity inflation. He emphasizes that markets have been distorted for years by financial engineering and derivatives, but that reality is catching up.
And if you look with that chart right there, you see that how many years is that? 1, 2,
3.
Yeah, almost 3 years. You can see the bottoms in that sequence. You know, at bottom we get a bounce, at bottoms and we get a bounce. This time we've broken through that support, and it tells me, you know, you've got downside to find another support level from here.
Right. So yeah, there's
Of
that.
course, Danny, we're talking, you know, technical numbers here. In today's world, as I just mentioned, you know, you wake up one morning to a disastrous fundamental event, and you could see the dollar quickly in the 80s. Well, you've got some foreign flow from a fear standpoint, but I think rather than looking at the noise right now in that market, I think it's important to understand that the last big event was the Federal Reserve cut once or twice or 3 times. They cut a full 1 percentage point, but if you make that chart go back further, you'll see that from where the Fed started cutting rates, interest rates on the 10-year Treasury, or across the board really on the yield curve, are up 1 full percentage point. So
Right.
the Fed cut rates 1%, and market rates went up 1%. That suggests to me that the Federal Reserve is losing control of the yield curve, because you're talking about an unbacked fiat currency, the dollar, which is the base of all of this. And the bottom line is the dollar is intrinsically worth 0. So I think they're both wrong. I mean, it doesn't matter whether rates go up, down, sideways. The bottom line is they no longer they don't have a collar on interest rates anymore. They can't control interest rates. And that's a problem to the U.S. Treasury, because they continually have to borrow. I mean, just on this big, beautiful bill is going to increase the debt by $10 trillion in 4 years. And it all goes back to Richard Russell's inflate or die. Either they can get the system reflated again, or it's completely over. You'll see a debt implosion. No, I think, and I've said this for years, the final episode is going to be a massive deflation of the things we have and a massive inflation of the things we need to live on a day-to-day basis.
So rising commodity prices, sounds like.
Well, rising commodity prices, high inflation, high unemployment. It's going to be the worst of all worlds, because the world for so many years has been masked, if you will, to show a narrative all is well. But they've done that with derivatives to price various different markets. And now the pricing mechanism, I mean, markets are so far out of whack as far as relative pricing. There's got to be a reset. And that's what we're headed for now, is a man-made reset, which I think will fail. And Mother Nature's reset is going to be extremely severe.
What we've just heard from Bill Holter isn't some fringe theory or market exaggeration. It's a sobering assessment from someone who's spent decades studying the inner mechanics of the financial system, someone who understands how vulnerable the global economy really is when trust begins to break down. And make no mistake, we are witnessing that breakdown in real time. Across every major asset class, signals are flashing. The bond market, once the bedrock of financial stability, is now sending tremors through the global system. Trillions in debt are being issued with no real buyers, only monetized by central banks or absorbed through distortion. Long-term yields are rising even as rate cuts loom, suggesting a system out of sync with itself. And as Holter noted, this isn't a temporary anomaly. It's a sign that the world no longer believes in the fairy tale of infinite debt and unlimited fiat creation. Meanwhile, silver, the most overlooked asset in the precious metals space, is rapidly emerging as both a monetary refuge and an industrial lifeline. While gold has already made its move, being accumulated by sovereign banks in record amounts, silver is still flying under the radar of mainstream finance. But that may not last long. The pressure building in the physical silver market, particularly from massive delivery demands, is unsustainable. If delivery obligations cannot be met, then the illusion of stability in the paper silver market could be shattered in an instant. And that's where things become dangerous, because once confidence breaks in one part of the system, contagion spreads rapidly. What Holter is warning us about is not just a silver event, it's a systemic event, one where trust in fiat pricing mechanisms, in paper contracts, in digital claims, all begin to unwind. It's not about whether you hold an ETF or a futures contract. It's about whether what you think you own actually exists. And in a world where trillions of dollars rest on derivatives, leverage, and financial engineering, that question becomes existential. And let's not forget the broader context. The U.S. national debt now exceeds $37 trillion. The projected debt growth over the next 4 years is another $10 trillion. There's no way out of that mathematically without either default, devaluation, or both. And when that day comes, real assets, those that can't be printed, diluted, or rehypothecated, will matter more than ever before. That's why silver matters. It's not just a hedge. It's not just a commodity. With its dual role in monetary history and modern industry, silver stands at the intersection of everything that's broken and everything that could still be rebuilt. So the question now isn't whether silver will rise. The question is whether the system can hold together long enough to keep pricing it accurately. Because if a delivery failure occurs, or if investor demand overwhelms the supply chain, we could see a price revaluation that rewrites everything we thought we knew about precious metals, inflation, and systemic risk. If you've made it this far in the video, you're clearly paying attention, and you're ahead of the curve. But now is the time to ask yourself, are you prepared? Are you positioned not just to survive, but to navigate a world where the old rules no longer apply? We'd love to hear your thoughts below. Do you agree with Bill Holter's assessment? Are we on the verge of a historic inflection point, or is this just another market cycle playing out? Let us know in the comments. Your insight helps drive the conversation forward. And if you found this video informative, please like it, share it, and subscribe to the channel. We're committed to delivering the highest quality coverage on gold, silver, and the unfolding financial transition. Hit the bell so you never miss an update. Thank you for watching. Stay alert, stay informed, and above all, stay resilient. We'll see you in the next video.